Hi guys, with the rising cases of corona, I wanted to make a second video looking at EU markets and whether they deserve a second look and contrast that to the bouncy US. So let's get into it. Hi, I'm Fifi, a mom, engineer and consultant living in London, and I make videos about saving money, investing and understanding the economy to make better financial decisions. Swift recovery, a term that keeps coming round and round. What a load of nonsense, don't you think? That talk of swift recovery is just a distant memory, and across the European continent we're accepting and also acknowledging the second wave is now here. Welcome. Governments across Europe are tightening restrictions, if you haven't noticed. Spain has declared a state of emergency in Madrid and a lockdown. London is teetering on a full UK lockdown, as are other major cities. And with that, economic gloom is spreading. France now expects activity to remain at 95% of pre-pandemic levels for the rest of the year. And Spanish business sentiment hit a 4-month low only last month. And the pan-European index, Europe Stocks 600, which covers about 90% of the free float market cap across Europe, is down 11%. Can you imagine, actually, so far this year, 11%, and the year isn't even over yet. The general conception is that Europe, old, stuffy, full of the old economy, while the US races ahead with a tech-focused economy. Let's quash that myth a little bit with some sprinkling of facts. So the perception that banks and energy firms make up the bulk of EU markets is no longer the case, and the idea is completely outdated. So indeed, the weighing of banks on the EU indices, is what I wanted to say, is now the same as the global average. Can you imagine? Just listen to that again. The weighing of banks on the EU indices is now the same as the global average alone. They were. In fact, the areas where the European markets are overweight are healthcare, consumer staples, industrials, and we need all of those things, so they're here to stick around. So Europe now also offers a healthy mix of good quality growth stocks. So the European leopard is changing its spots. That's actually got me quite nostalgic about a holiday to South Africa. Not just that, but holidays in general. So the US is betting on tech, and to make the same analogy in Europe is that we as Europeans are betting on drugs. Let's sprinkle some more facts. About 5 out of the 10 biggest firms in Europe are drug firms. Compare that to 15 years ago, where the top 3 firms were British and were BP, HSBC and Vodafone. Today, the leading trio are Swiss-based. We have Roche and I can't even say it. So we have Roche and Novartis, drugs obviously, and Nestle, also Swiss-based. Whenever I think of Nestle, I think of the bunny rabbit. Remember Nesquik? Nestle. Anywho's, Nesquik, Nestle. By the way, having said all of that, there are other nice growth areas too, like French luxury goods like Hermes, which is a firm favorite, or Danish clean tech firms. But the US has no doubt absolutely eviscerated all other markets over the past decade, returning 13.9% a year on average over the last 10 years, while the rest of the world has been trying to catch up with an average rate of return of 5.5%. It's quite nuts, really, when you think about it. You guys in the US might be trying to do a little bit of soul searching. With the valuations as high as they are, there is some portfolio globetrotting to do. And in fact, an eye-opening statistic is, if you strip out expectations, which I don't think is the right thing to do right now, but let's do it as an experiment. Equities themselves are priced to deliver about 0.5% annualized return for the next decade in the US. And on the flip side, Europe and Japan are set to offer a real return of about 5%. Then we have to talk about the DAX. Germany has proved a stalwart through the pandemic in Europe, and it has actually outperformed all other European markets this year, falling by just 2.2% in the entire year so far. And why is that? Well, it's an export-led economy with a nice beta to the strong Chinese recovery. And in fact, we should be expecting car makers to do even better. Another thing to note is Germany also had a very strong balance sheet coming into the pandemic, and that should be an important lesson for all of us, which made them very resilient to the crisis. So now let's switch to the US for the moment. And as I'm talking about this, the US has experienced their best week in 3 months, with the S&P 500 advancing 3.8% despite all the political deadlock and uncertainty over key matters like the stimulus bill. But last week, the Nasdaq had its best day in 6 months, with Joe Biden now looking more and more likely to be the next president of the US. Markets are actually expecting a post-election stimulus binge. What do you guys think? Let me know down there in the comments below. The new mood is also pretty evident in the fear index, the VIX. It's even got quite a fierce name, right? It's retreated about 16% in the last few days from its high in early October, and that is despite all the news that Biden will raise taxes. And normally the VIX spikes like this and leaves stocks down by about 5%, but not anymore. But should we actually be surprised that tech stocks themselves are again leading the rally? With all that pressure from increased regulation, antitrust laws, high valuations, Apple were up over 6% on Monday, and also options are on the rise, with traders taking leveraged bets on the sector continuing to rise. So we also have this third quarter earnings, and general consensus is that quarter-on-quarter earnings are set to be 18% higher, guys. That itself would still leave the S&P down 21%, and this time last year on EPS alone does suggest that things are going in the right direction. But that being said, you don't need to look too far to hear the concern around valuations themselves. And so in the long term, is it inspiring? So there you have it, guys. Let me know what you think down there in the comments below. In the meantime, here's a few more videos around the general topic, but let me know your thoughts. Cheers, guys.